welcome back to Yuri's Box. In this video I'm going to talk about TLT, the week ahead. If you like this kind of content, consider leaving a like, and as usual, nothing I say in this video is to be considered financial advice. So you really have two things, two data points I think you really should be looking at, and that is the JOLTs report, the job openings and labor turnover survey. Got it right at the first time. And with it, you have really the headline number, which is, of course, the number of job openings you have in the US. But I've made the case why it's not worth to pay too much attention to the headline number because it's very noisy and very flaky. What you really should be looking at is the job quits. And the reason why, I've made that quite clear in my previous videos, but in case you haven't watched them, the quits rate really is a survey of people's actions rather than people's words and opinions. So it's kind of the direct competition to something like the University of Michigan survey. And the reason why I don't really follow the University of Michigan survey and things like that, either positive or negative, is because people's opinions can be skewed by political leanings, most of all. So I'm sure if you're watching this video, you follow financial news, and I'm sure you've seen inflation expectations kind of break out. Now, I've shown in my previous videos how a lot of that has due to the fact that Democrats, ever since Trump got elected, are expecting hyperinflation. Okay, now that is not me, pushing any kind of judgment on people that vote for the Democrats. It's just pointing out a fact. Before the election, Democrats were positive on inflation. After the election, Democrats are really worried about inflation. And again, that just goes to show how, if you ask someone their opinion, chances are you're going to get a signal that is very, covered with noise, filled with noise. The quits rate is just a perfect way of eliminating all the noise. It's not a matter of opinion. It's a matter of fact. What are people doing? Okay. When the quits rate is high, for instance, people are telling you that jobs are plentiful. And because jobs are plentiful, they have the leverage in the labor market. So you have upward pressure on wages, because if you have another job you can go to, you can use that as a bargaining chip when it comes to asking for a higher wage. When you have a quits rate that is low, you have the opposite. It's an employer's job market, so employees no longer have the leverage in the market, and so wages tend to stay flat. Okay, wage growth tends to stagnate more, which then feeds into to consumption, and that is why I like to overlay the inflation rate. Okay, you can have this kind of inflation, this breakout in inflation, if you have the labor market being a source of inflation. Okay, having that that wage growth that is quite significant. And again, if you have the quits rate being low, that is just a signal that inflation is probably not going to be your biggest concern. People are holding on to their jobs and they're acting defensively. So again, that I've spoken a lot about this in my previous videos. I'm not going to spend too much time on it. Again, it just drives the point home that things in the labor market have cooled. So we have that number getting released. Watch for job quits as a further indication. The big caveat is that this is January data, so it's really outdated. So it's kind of irrelevant at this point, although markets will obviously kind of extrapolate things from it. The big data point is CPI, okay, so the inflation rate, and consensus sees a decline. The way things have moved in recent in recent weeks. So you've had a sell-off in stocks and a rally in bonds. If you were to see a slight miss, so instead of coming in at 2.9, okay, on the headline, say we come back at 3%, I think stocks could possibly have more to lose than I mean, bonds have more to lose, yeah, than stocks at this point, simply because we've seen quite the move already in bonds, and stocks have really discounted a lot of fear. So if we were to see a miss, I think so inflation coming hotter than expected, I could see stocks outperforming bonds. If it comes in line, I think it just confirms the status quo, so uncertainty, and it could also lead to the rally I was talking about in my previous video. So if it comes in line, I wouldn't be surprised if we see something like this happen, like from the low Friday. If we see something like a 5% rally back to the bull market support band, and then decide where we are from then on, from that point on. So again, look for CPI. If we see it coming hotter, I think bonds will bear the brunt of it rather than stocks. If we see if we see inflation coming in cooler, or say 2.8 or 2.7, I think it would be a bigger tailwind for bonds than stocks, because inflation coming down significantly could also be extrapolated as overall activity declining. Something like we saw in June, if I'm not mistaken. In the June CPI report, we really started seeing the disinflationary trend, kick in, into third gear or fifth gear, really. Third gear isn't that much. But in any case, if you see, so kind of to summarize everything up, CPI coming in slightly hotter would be worse for bonds than stocks, in my opinion. In line would leave room for bonds to rally a bit more, but it would really just give risk assets to have at least a short-term rally. Anything cooler than 2.9 would give bonds a much bigger tailwind, as it would probably mean that, again, activity is slowing. So again, you have less pressure on inflation. After that, you have initial jobless claims. And right now, consensus is at 225. Again, in my previous videos, I made the case for initial jobless claims to slowly grind higher into the future as we move towards the summer. Okay, like we saw last year, so a bottom in January, and a slow grind higher towards the summer. Could we see it go down to 210 to 215? Which, by the way I kind of navigate the initial jobless claims number is anywhere between 215 and 220 is kind of status quo. So it kind of makes the unemployment rate, I mean, my expectations for the unemployment rate, as long as initial jobless claims stay between 215 and 220, is status quo, so unchanged. If it comes below 215, so initial jobless claims come below 215, it makes the case for unemployment rate going lower. And if you see jobless claims going above 220, you can start to make the case for the unemployment rate to move higher. Again, it'll just be a matter of looking, week by week, how the initial jobless claims come in. If they come above 220, and that's just my personal opinion, you could easily make the argument that the unemployment rate is going to move up as well in the month of March. Okay. Okay, so keep an eye on that. Keep an eye on the initial jobless claims. And that is really it for this week's data. Again, CPI will really move things in the short term. If things come in line, again, you could see like stocks rallying. Again, given the fact also that the previous non-farm payroll report that we got on Friday really wasn't that terrible. Of course, it leaves a lot to be desired. Like, you still have a lot of questions about the future, and given fiscal tightening, given tariffs, given the yen, what it's doing. But in the meantime, you have this window between now and the next economic data round of economic data, where if again you have non-farm payroll reports coming in not terrible, and CPI possibly coming in line, where it could actually leave the door open to a small short-term rally. I wouldn't be surprised by that. So from these lows again, something like a 5% rally back to the bull market support band. Okay, like that. Let me zoom in so you can see it better. Okay. I wouldn't be surprised if in the following weeks you see something like that, a 5 to 6% rally, even going, peaking above the bull market support band. That wouldn't surprise me at all. Anything cooler than 2.9 would just continue to push potentially the narrative that things are slowing down, and so it would actually be a bigger boost to bonds, in my opinion. Anything hotter would be actually, so a miss, say 3% or 3.1, would put bonds in a position where they have more to lose than stocks, in my opinion. Okay. And again, just to go back over the initial jobless claims, keep an eye on the number. If it comes over 220, again, that's kind of my line of the sand, my personal line of the sand. If you see something a number come above 220, it just adds to the case that potentially we might see the unemployment rate go up in the month of March when we get that non-farm payroll report in the first month of April. So that's really it. That's pretty much it. As far as the price action is concerned, we closed last week with a kind of a retest of the bull market support band. We are currently holding support right here. So again, if we get a really cool number on CPI, it's a big boost to TLT. If we get something in line, it would be more of the same until the next bout of economic data. So again, not great expectations, but at the very least, it wouldn't be a headwind. And if we get a hotter number, expect bonds to have more to lose than stocks, and it would actually leave the door open for something that has been bugging me for quite a bit, which is actually a retest of the previous trend line. Again, this is something I would see happen only if we get a very hot CPI print. So if CPI comes in at 3.1, you could see this happening. If it comes in line or below expectations, so a cooler number, I wouldn't really worry about short-term price variations. So those are the things to look at. I'll leave it short. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.